Hey, welcome back. Continuing on with our volume analysis. So this is a interesting one. Volume, the technician's decryption device. Almost sounds like a secret code of some sort. So we're going to look into a couple of different ways of using volume and a couple of different indicators around volume as well, and different chart styles. So looking at those. So obviously state implications of volume changes, price trends. Again, we're going to be reinforcing what we've talked about in the previous introduction to volume analysis. Identify trends in price and volume in a chart. Describe how volume is displayed in a volume at price chart. It's a different type of chart there. Define VWAP, define equity volume charts. Explain how open interest rises and falls, and state the implications of open interest changes for price trends. These ones, you'll see we've got a couple of tables. Just print out the tables and memorize them. It's really what you need to do here. Okay, let's jump in here. All right, decoding volume. Volume is the code that tells us what's happening in the market. We've talked about this now at length. Extraordinarily high volume is the clearest signal that the market is poised to move. So when we see that really high volume, we know something's going on. Remember when we talk about patterns, our descending triangles, wedges, those sorts of things, we see the volume drop as the pattern gets longer and longer and longer. It's not until we get some sort of breakout that volume spikes again. And that's because really in most of these patterns, there's this sense of equilibrium which has been found. And so that's why, volume starts to decline as we go through time. Imagine high volume being like bold print saying, warning, something big is going on. That's essentially how, we could think about volume, as volume spikes, I should say. So we've got this table here, price volume relationship printed out. When price is rising, volume's rising, we're in a phase of increasing demand. And this is one of the terms that we're going to talk a lot more about when it comes to volume analysis, is this strong demand, strong supply, and weak supply. So demand and supply are really important here. So, but we're in this phase of increasing demand, and the implication is bullish for the market. When we see price rising but volume falling, then yes, there's still demand, but it's decreasing. And that's actually a bearish sign, almost like a divergence in some respects. Price falling, but volume rising. Then we have increasing supply. Anytime volume rises, it confirms the trend. And so because prices were already falling, it continues to be a bearish sign for that security. And then if they're both falling, then it's a decreasing supply. And that's actually a bullish sign. We may be nearing the bottom of a correction or the bottom of a downtrend there. All right, so volume under price. So when we look at our volume here underneath price, we can see all these different phases going on. So I've labeled them. There's a different example in the text. So it's worth having a look at the text and what the examples that they're showing, just showing you a couple of different ones here as well. So if we take the phase between 0.1 and 0.2, and you'll see that we had this massive spike up, big move up, big spike in volume, and then immediately the next day the volume dropped. Well, that'd be a warning that this move is unsustainable because we don't have follow-up volume going on here. And so as we take this phase between the spike here and this really low value of volume down here, we can see that the market's gone sideways. So we have this period of falling volume. Again, market's kind of going sideways, maybe a little bit up, but definitely, we would be looking at that and saying, hey, there's not much conviction going on here. I guess if we were to consider this to be a down move, we would be then saying, all right, that's decreasing supply. And so based on the table before, we'd consider that to be a bullish move. 2 to 3, what we've got here is rising volume. So from here, we've got volume generally rising. It's obviously had a drop here. Interestingly, that drop was on the one black candle, so the down candle. So there wasn't much conviction about that down candle there. And then it continued to rise through that. So rising volume, rising prices, increasing demand. 3 to 4, we have again falling volume. Prices kind of staying steady, slightly down there. I think what's interesting about this one is that there was this thrust up at the end and on volume, but wasn't sustained. Now there we can talk about resistance levels through here, couldn't break through, volume started dropping away. Now this one's a little hard because we've got a pretty significant downtrend going from 4 to 5. And we had this initial rise in volume. Actually, the rise in volume here is on this candle. It's a little hard. I should have put the grid on. But we've got that candle there. And so we have this initial rise into the first bar down or candle down, and then prices fall away as well. So really, we've got this increasing supply and then decreasing supply as it keeps going down. They're not always going to be so blindingly obvious that it's really easy to see. Most times we're going to see situations like this. Now, on a chart like this, it's really easy because we actually can cheat and see what's coming up. When you're dealing with, like this point in time and saying, gee, how am I going to interpret this? Obviously, this down candle had a lot of volume and then the volume started dropping away. And now we've got an up volume, but it's even on an up candle, but even on lower volume. Well, how are we going to interpret that? I'd be saying this is all pretty weak still. Yes, it looks like decreasing supply, but that up candle still didn't have significant volume for me to think that there's a bullish reaction going to happen anytime soon. All right, volume at price. So we'll talk about market profile, I think more on CMT2 than now, but essentially volume at price is like market profile. And what it is that we're looking at each of these prices and seeing how much volume traded in that period. And then we add all of that up. If you're familiar with the game Tetris from the 90s, probably, is very similar to that, where it all just stacks up and we're stacking all that price action up with a consideration to how much volume was traded, and we get this plot. Now, what this plot is telling us is that most of the volume happened in this period. Now, this is like standard deviations that we show in the Optuma one, but we have these points here, and we know looking at that most of the volume through this period has happened there. Now, when we talk about this, particularly more on an intraday basis, it's a measure of the conviction behind price. And so that's where we use that. Now, this point here, the tallest bar, or the longest bar, I should say, is what we call our point of control. So that's the point at which we see the most volume at any one price. But as I said, it's variation of the market profile. I think for the exam, I think what you've just got to know what volume at price is and how it's made up of counting the total volume at different price levels. And the one with the most volume is the point of control. I think that's the key information that you'll need to know. All right, VWAP, volume weighted average price. This one's used a lot. We already talked about VWAP when we were talking about how institutions want to disguise their buying and selling. They look at VWAP. But basically what we're doing is we're finding the price for each day, which represents the weighted average. So if I just took, let's say, the high and the low and I divided by 2, I'd get the middle of the bar. And we could say, oh, that's the average price. Or I could take the open, high, low, close and average those 4 numbers and get, an average price in the middle of the bar. What that doesn't tell us, though, is usually at the extreme highs and lows, volume's fairly thin. Most of the volume's happening around the middle. Or maybe we had a lot of volume early in the day and the average price would be down lower. So what this does is it looks at all the individual trades that happen in the day and it says, all right, if the prices are all down low and we had a lot of volume down at the bottom of the bar, then it's going to move that average down. And so it gives us a volume weighted average price. And so it becomes a lot more accurate and a lot more important to look at when we want to know, where did most of the trades occur in that period. So, in the text, they say VWAP is more of a statistic than a true indicator. I'm not sure I would give it that distinction. It's an interesting one. Nevertheless, just make sure you understand how VWAP is calculated and what it's trying to tell us as well. All right, institutions use VWAP to disguise their trades, like we talked about before. We don't want a large single order, which is going to move the market. And so what they're doing is they're waiting for price to get around VWAP. So this is a daily chart showing VWAP. So it's joining the dots for each individual day. What we got here is a 1 minute chart, and we can see how VWAP forms over the day. Now, we know that there's a lot of volume always on the open. So we can see this volume spike in the first minute of the day, and VWAP is jumping up and following price really closely. And then as the volume lowers through here, VWAP is sort of staying at this average price, based on the volume weight there. And it's not until we get this peak or this rise in average volume around here that we see VWAP start to rise a bit and go through there. So yeah, very interesting. Traders aim to dollar cost average by trading small lots. So an institution, they'll, instead of doing one big order, they do lots and lots of small orders, just trying to fly under the radar as they liquidate out of their positions. And VWAP is the benchmark that they use for that. Equity volume, we talked briefly about that in charts. Again, it's a box drawn for each period where the width is determined by the amount of volume that traded compared to the average. Looking at this, if you were to average up the whole volume traded through the whole day, then work out the average volume or the volume for that day and how does that compare as a ratio. The height is the range, the normal price range of that day or that bar. Richard Arms, who created this concept, calls a box like this a power box because it has such a big impact on the chart. And that's what he was trying to show here with this. Remember that the x-axis is not a linear scale. It's not even intervals when we have charts like this. Power box during a breakout indicates a high probability of success. I think that is an important thing to remember as you go into the exams. I can see that's a very likely question there. All right, open interest. Now, we talked about open interest before, the number of outstanding futures contracts which are waiting to be delivered. Now, we've got buyers and sellers in this scenario. And again, it's different whether the buyer is a short person who is covering their position or it's a long person who is buying a brand new contract. So we'll look at that table in a moment. Remember that new interest into the market, so when basically rising open interest is the result of new buyers and sellers coming together and writing a brand new contract. So if I come and I want to buy, but there's an existing holder who wants to sell, well, then that's not going to change the open interest because the seller in that situation already has a contract and they have to deliver on that contract at the delivery month. But if I come and buy from them and they're the person I transact with, well, that doesn't change the open interest. All that's changed is the obligation has shifted from the seller to me as the buyer. And so that's why you can get these trades going on and volume going up, but no change to open interest. The total open interest is the total for all delivery months. Now, normally when we talk about open interest, it's just for that one delivery month. Usually, probably the nearest delivery month is the one that we all focus on in futures, but total open interest is for all. I think that little statement is something which can be asked a question on, so make sure you remember that. So looking at this table, so as we said, we've got a buyer. The buyer here is a new long position. The seller is a new short position. Well, in that case, we're not taking up anyone else's contracts, and so a brand new contract needs to be written. And that's when you're going to see open interest increase. Now, let's take the opposite case of that one. If the buyer was a current short wanting to cover, and a current long, the seller was a current long wanting to sell out of their position, well, then those contracts cancel each other out, and we're going to see a decrease in open interest. Now, in these other two cases, if I've got a brand new long and I'm buying from someone else who is holding a long contract, there's no change. All I'm doing is taking that contract off them. If the buyer is a current short wanting to cover, and the seller is a new short who wants to take a short position, well, again, there's no change in open interest. That contract has just gone from one person to the other. All right, so volume and open interest. Interest increases during a trend. So like we expect volume to increase, we also expect that to happen with open interest as well. Volume declines, but open interest increases during accumulation. So when we have these big patterns and we see volume starting to drop, we often can see open interest increase during that period as well. Rising prices but declining volume and open interest indicates a pending change. So again, we have a table here for volume, open interest, and how we interpret that. Just memorize this stuff. So rising volume, rising open interest is confirmation of the trend, and we'd expect it to continue. Rising volume and falling open interest means that the interest is waning in that, and we would expect change in trend at some point. It's kind of an interesting one because the volume rising can be the result of people just covering out their contracts, and so you will see open interest drop usually before volume drops. And then, again, so the falling open interest can be an early warning that volume's going to start falling fairly soon too. Falling volume but rising open interest is a accumulation or weak accumulation. And then falling volume and falling open interest means that the trend that we see is actually being contradicted, and we should be anticipating a change of trend to happen fairly soon. So here's a couple of examples of that, looking at volume, a moving average of volume, open interest and price. So here we see falling volume and we see slightly rising open interest. And so we call that an accumulation phase there. In the green here, we've got rising volume and we've got falling open interest. And so we're calling this a waning interest at this point. And probably here, you can see that's at the end of June. There's probably a change of contract going on around about then, which can explain a bit of why there may have been a bit of waning interest. Probably we would have expected that to roll earlier. I think these ones are just on, it's a volume spot. So it's rolling on volume rather than on open interest. So blue here, we've got rising open interest, rising volume, and we've got price, which obviously is going up initially. So it's confirming that. Then we have, the smaller drop, but again, essentially it's confirming the changes in trend for us there. And then this orange at the end, we've got falling volume and we've got falling open interest. And so it's a bit of a contradiction to what's happening in the trend. And again, we can see that through there with the uptrend not being sustained, volume falling through that and volume falling again as well. All right, so putting all of that into a single table for prices, volume, and open interest. If prices are rising, volumes are rising, and open interest is rising, the implication is that new buyers are entering the market. If we have the case of prices falling, volume falling, open interest falling, well, the implication there is that longs are being forced out. We're basically getting to the bottom of the run, and we can expect to see a bottom being put in fairly soon in that. So if prices are rising but volume's falling and open interest is falling, then what we believe that to be is short sellers are covering their positions. The fact that the volume's falling away, the open interest is falling away, shows that there's a lack of conviction in that price. And as I said, the implication is short sellers are covering their positions and it's causing a small rally, but that won't be sustained. Once they've covered their positions, then the buying pressure's gone. for that. Remember, when you're covering a position, that contract disappears. And so that's why we get the decreasing open interest there. And the falling of volume just means that there's less and less of that going on. So again, prices falling, but volume and open interest rising. New short selling is going on. Bearish money is entering the market. So again, when these two are in tandem, it's really confirming what price is doing, is I think the simple way of looking at that. All right, so the implications of volume changes. Look, there are those tables there. Print them out, remember them. We often see exams, questions around those tables. So make sure that you memorize those tables and what they mean. Identifying the trends, defining VWAP, volume at price chart and equivolume. Make sure that you're familiar with those concepts, what they're trying to show and how they're calculated. Very important. And then obviously the implications of open interest. All right, so that's Volume, the technician's decryption device.